welcome back. Welcome to the show, Josh.
Yeah.
Thanks for having me.
No, we're happy to have you. Today, our guest is Josh Sasouness, and he's co-CEO of Dwight Capital. And just real quick about Dwight Capital, Dwight's a national commercial real estate banking firm and loan servicer with a portfolio exceeding $12 billion, including balance sheet bridge and new construction loans, FHA, HUD insured loans, C-PACE financing, mezzanine financing, and preferred equity. And Josh's role, he leads a specialized mortgage banking team whose focus is set on nationwide FHA, Fannie Mae, Freddie Mac, CMBS, and bridge origination. And throughout his career, he's originated $10 billion in transactions and has built a vast network of owners, developers, and operators nationwide.
Well,
Am I missing something?
Is that true? What Jack's
is all
saying
that
about
true?
it?
Yeah. Do we? I'm missing something.
No, that was just a little understated.
Yeah. And he's a cool guy. No. And he's founder and partner in Dwight Mortgage Trust, a premier commercial mortgage REIT, Dwight Funding, an asset-based lending company, and Dwight Citigroup, a commercial real estate investment company. So you've been pretty busy.
Yeah.
Did I get most of it? Is that?
You got most of it.
Okay, good.
You got most
Great.
of it.
Yes.
It's good enough.
Let's get into like really hard hitting questions. We like to start with what's your credit score and who are you voting for?
Credit score actually,
all the real like easy,
credit score actually dipped recently
Damn.
to a low level because the auto pay got messed up and there was
that'll
like
do it.
2 missed payments and it like went on my credit report.
Now
Well,
you gotta
that's
go
not.
through-
How's your social credit score?
Yeah.
People
So
still
that-
like you.
That's
So we had to hire a consultant to come and fix it.
well, that's never fun.
Yeah. So as you can see, nothing's off limits. If you ask a question, I'm going to
I
answer.
love that. Well, that's why we call it no cap,
Yeah,
because
That's great.
nothing's off limits.
Like that. No cap on my coffee.
No cap in your coffee.
And there's no cap on Josh's coffee. Yet another meaning. I love that.
It's perfect. Where'd you grow up?
Alpine, New Jersey.
Got it. Good Jersey boy. You're
Yeah.
a big Springsteen fan.
No, I'm kind of more into house music.
Yeah, that'll do it. Well,
Nice.
that makes sense. That's
But
you're
Springsteen's great.
You're true to your Jersey roots.
Yeah. You got to
Don't shine
support
away.
him a little bit still.
Yeah, I mean, just objectively, he's great.
Yeah.
Yeah.
You know?
You're not going to every concert.
Who doesn't like Bruce Springsteen?
No.
No. You're not American. Yeah.
Where's your family from? Israelis?
Persian.
Persians.
Yeah.
Okay.
Both my parents immigrated to the U.S. Independently of one another when they were 18.
And they met here.
Met here.
Wow.
That's cool.
Cool. And they met in Jersey or?
No, just New York Metro.
Okay.
They
Fair
got
enough.
set up.
So you got siblings. You got your brother. You run Dwight with. Any others?
Younger sister,
Got it.
who also works within Dwight.
Oh,
She leads our marketing team.
Oh, cool.
family businesses are really cool. What's your parents' background? What are they like?
In terms of
What do they do? Are they schooled? They're immigrants. You're first gen. What was like growing up like?
grew up in an immigrant household.
Yeah.
Do you find that means they're usually a little bit more entrepreneurial in that regard?
Yeah.
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 I see that happen a lot too.
Yeah.
Yeah.
And I think a lot of my motivation is a result of like their history,
What
right?
did your dad do growing up?
So initially he was in real estate and then he moved into retail, which my mother worked in as well.
Got it.
And then after retail, back to real estate.
Got it.
So,
Did you learn from him in the real estate business?
yeah, no, I wouldn't say that, my father's definitely, maybe the biggest influence in my life, right?
Mhm.
Generally speaking, including business-wise. But there were many cooks in that kitchen from the business perspective. But, dad's definitely top 3.
Tell us how you got into Dwight. Also, where the name came from. I know a lot of our listeners had asked us about that. That's not true. No one asked us about that. But if we had listeners, they would be asking us
Yeah.
that. And,
Imagine we had listeners.
Yeah.
When
Yeah.
you have
That's
listeners.
right.
When we have listeners.
right.
Yeah.
So tell us about Dwight, how it came to be, and all that good stuff, and the name.
Sure. So my brother Adam and I were, right out of school, very successful, young age. We just, forget about hard work. It was sacrifice. We literally cut out every other aspect of our life in order to work and be successful. Because we realized early on that it's all about those marginal hours, right? The level of intelligence between you and your peers is the delta is nominal, right? But that delta compounds with more sacrifice and more margin hours you put in. So we quickly realized that, and that's been our theme since day one. So really, it's again, hard work is like a joke, right? Hard work is a given. It's more sacrifice that was what we took advantage of the most.
What did you guys start doing?
For better or worse. So we jumped straight out of school. Effectively, we went and worked at Greystone.
Okay, where was school?
GW, DC.
Oh,
Okay.
DC. I lived in DC for a little while. Yeah.
This isn't about you. Okay,
All right.
it's about
Jeez.
Josh.
Kill me for making a personal relationship.
Go Patriots, right?
Yeah. Colonials.
There you go.
Colonials.
Yeah, Colonial. I knew it was something. Like,
Yeah.
yeah. And your brother, where
real cool, Jack.
Your brother, where did he go to school?
It's 810 school. Who cares? NYU.
Cool. Okay.
Yeah.
Awesome.
So we teamed up. My brother graduated a year older than me. He started in commercial brokerage in New York City in 2009, which is probably the worst time in history to get involved in that business. But
Or the best time, right? I mean,
yeah. Yeah.
stick with it.
Sure. Or the best time.
Sure. It was positive, right?
Yes.
Positive, yeah.
Yes. He started working over at Greystone as soon as I graduated. 6 months later, he's like, we got to do this together. And we did. So we became very successful at a young age. We grew a team of 8-9 people.
So how'd that work? Did you guys just kind of get together and say, hey, let's have our own team and build it out? Or were you part of a greater team at first? Or were you always part of a greater team? How did that all kind of?
So it's a good question. So we worked within a team.
Mm-hmm.
And then, our level of success was just
kept growing.
Kept growing to
Mm-hmm.
the point where we were outproducing the entire rest of the team, including our manager, who's a wonderful guy.
Yep.
But it was just like, okay, we don't belong on the team anymore.
Yeah.
Like we're like 2x, 3x the rest of the team.
What do you think your secret was then? I mean, it seems like it all happened pretty fast. You just worked really hard. Were there a couple of key clients that helped you kind of get in the door with the others? Like what sort of was the catalyst, would you say? There's always something, I feel like, right?
I wouldn't put it on one thing.
Mm-hmm.
Again, it was the sacrifice. And I feel like, I don't know, I'm a big believer in the magic happens in the most extreme moments, right? And when you're coming to the office at 8 a.m. and it's midnight,
Mm-hmm.
right? And you're firing off emails at midnight, or maybe you may be fielding calls from the West Coast.
Right.
That's, I don't know, universe, God, whatever you want to call it. To me, that's when the magic happens. And there was a lot of that, particularly later on in the evening.
So give us your trajectory. You guys were originating loans at the time?
Yeah. We were originating, FHA loans, HUD loans.
Yep.
For multifamily properties, solely, right? Because HUD covers both multi and healthcare, but at the time it was solely multi. And that's all we specialized in. That's all we did over there.
Got it. So you guys really grinded and kind of filed your teeth at learning the multifamily business, learning the loan process.
And tell us really quick for listeners that may not know, so in multifamily, traditionally you have, agency debt that a lot of buyers and borrowers like to use. That's usually, Fannie or Freddie, agency, fixed rate, usually long-term loans. What differentiates HUD for the most part from sort of your traditional agency financing?
Sure. So HUD on paper is the best loan in the universe,
Mm-hmm.
right? Just objectively, right? It's the longest term, longest amort, lowest DSCR, lowest rate out of any permanent loan program that exists, right? Maybe there's obscure programs here and there that may be better in one category or the other, but generally speaking.
So 35-year AMs, 40-year AMs versus a traditional 30-year AM.
Right. Now, the drawbacks are HUD loans have an explicit guarantee from the U.S. government, whereas Fannie and Freddie have implicit, right? Other programs have none, like CMBS or
Mm-hmm,
bank loans.
Mm-hmm.
As a result of that explicit guarantee, you're getting these incredible terms because the loan is 100% backed by the U.S. government, right? But it's a arduous, complicated process that takes anywhere between 6 to 12 months to close, and not everyone has that patience. Not everyone has that. Not everyone's willing to make as many administrative sacrifices to kind of get the organization to
be patient
and asset manage a HUD insured property effectively.
Right. And then, being in the multifamily space, I'll tell you a lot of pushback we also get, right, is the inspections.
Yeah.
So I know it's an annual inspection.
That's not really, the annual inspection for HUD.
Yeah,
it's not that big of a deal. It's like, they're just looking for life safety issues, that if your roof is falling off.
Got it.
Things that any reasonable owner would be taken care of, right? It's for lack of a better word, slumlords that would be dinged for that. But it's really not. It's immaterial. I would say that in the same vein, though, one of the drawbacks is the upfront engineering report, right? That's just going to be very heavy on reserves and repairs and getting the property set up for the long term, because it is a 35-year loan.
Are you looking to build sustainable wealth and achieve financial freedom? Viking Capital can help you do just that through multifamily investing. With a team of seasoned real estate experts, Viking Capital conducts deep financial analysis and data-driven asset management to deliver outstanding returns.
We got to talking about Dwight. So you guys started by working at Greystone out of college, built a high-producing team, kind of cut your teeth at the business. Where to go from there?
So Greystone's a great company. Not a bad word to say about Greystone. Really wonderful place to work, great leadership, et cetera, all the good things. Us as cocky, immature 24, 25-year-olds, suddenly the environment, the culture became a little too bureaucratic for us, right? We were probably wrong at that age. But that's what we had conviction of. So we just, we kind of butted heads with middle management, upper management for the course of, 9, 12 months. And then it came to the point where it was like, okay, this isn't going to work long term.
Okay. So you guys make your exodus. What does day one post Greystone look like?
Awful.
Yeah, it's got to be really a nerve-ridden period of time, I'm sure.
So there was 2 of the worst days of my life. Okay. Now, I would say, let's call them the worst days of my life, for, not to think about a way to present it better. But it was my first day of work at Greystone where I realized what work was.
Yeah.
Being in an office for like 16 to 18 hours a day. And I was coming straight from school. This was just so foreign to me. And I was like, okay, I guess this is what it's going to be like for the rest of my life. For the next, 30, 40 years, however long I'm working. So that was a tough day, just to kind of like internalize that. Yeah. It's like, oh, whoa, like this is reality. It's no more. There's no more fun and games like there used to be every single day.
Right.
That was the first day, and then the second kind of worst day of my life was the first day we started Dwight, because we went from this AAA office building, top floor. We had the whole corner of the top floor that was dedicated to our team with the most amazing views in the world. At
Greystone.
Yep. And we went to an executive office suite that fit like 3 people, and we had 5 or 6 in there. Right? There's no room to walk. We were like on 5th Avenue and like 46th Street or 44th Street, like on the 2nd floor overlooking a Staples. Right?
Yeah,
that was our view. And Wi-Fi went down on the first day for the whole building. Went down on the first day.
And you had nobody to call. Yeah.
Nobody to call.
That's on you.
That's on you. And that was the aha moment of like, what did we just do?
Well, you guys certainly have upgraded. I know one time when I was in town, I visited the office, and it was one of the cooler atmospheres I've been into recently. So, luckily you guys have grown past that.
Yeah. Well, to finish that story, by the way, which is I think is a very good representation of Dwight even still today, is we didn't just kind of like sit there and work on our phones. That first day when the Wi-Fi went out, we all went to the Verizon store like a block or so away, and we got jetpacks, right? So we worked off jetpacks for the next like 2 days.
It's the hotspots.
Yeah, the hotspots, which like I think they just started becoming a thing at the time. This is like 2010.
That's amazing. So you just found a way to just keep it going.
Yeah, just one foot in front of the other, right? I'm sorry, you went on to something else after I went back.
Oh, I don't know. I think it'd be great just to kind of talk more about how you grew the service lines of Dwight really. And
yeah.
jump into
So
that.
in terms of office,
your office is definitely upgraded.
Right, and I think it's important to note that's really important for us. Right, it's really important. We're
culture.
Things. Well, just the office space itself for us has always been important, right? Because we're like kind of claustrophobic and like we're all about like good energies.
Yeah.
So, any office we've been in since that executive office suite has always been, just very high ceilings, floor to ceiling windows,
natural
just
light,
good kind of feng shui.
You're spending most of your day there. Right?
Yeah,
exactly.
5 days a week.
Totally.
So.
Not only us, but so is everyone else.
Of course. Right.
Yeah.
Right.
They're living there.
Yeah.
Right. They're spending more time in the office than they are at home.
That's right.
Yeah. You want to incentivize people to be at work, which kind of goes into the whole office debacle that we're in today. But I mean,
I wouldn't call it incentivize. If you have to incentivize someone to come to work, that's a problem.
how about
I would say
you don't
be
want
happy.
them to be depressed the moment they walk in.
You want to treat people how you want to be treated yourself, right? And you want to be happy. And if you're in a position to make other people happy, you better do it, right? Otherwise, you're full of it.
Yeah. So day one, executive office suite, no Wi-Fi. What are you guys focused on? How did the culmination of what you guys have today, where did it start, and how did it grow into what you guys have now?
So we were unlicensed, right? Which we didn't realize how difficult it would be to get licensed. There's 3 different HUD licenses you have to get, and long story short, we were effectively brokering deals for our first, 6 months, right? And then we got first HUD license, which gave us the ability to do certain transactions. Then we got the second HUD license, which gave us the ability to do all different types of HUD deals. And then we got the third license, which allowed us to bring our servicing in-house, which we were farming out up until then because we weren't licensed to do it ourselves. So that, the first 2 licenses I would say we got within the first 12 months. It was like 6 months, then like the 9th or 12th month. And the third license we didn't get till year 3 or so.
Okay.
And how did that grow into, so you guys started with the brokerage and your roots, and then how did that grow into buying real estate, mortgage REIT, you mentioned the loan servicing. You guys have so many lines now. Where did these ideas come from? How old are some of these lines of businesses?
Yeah, sure. So they're all, kind of it all makes sense, right? The except for Dwight Funding, which is a great business, and we have great, amazing, super intelligent operating partners, but that's kind of the only irregular business within the Dwight & Co ecosystem.
Okay.
Right? But in terms of, when, thank God we were successful, right? And you have money and you want to place it, right? So, we also want to lean on our skill set. So you want to place the capital and you want to lean on your skill set. So naturally we went into acquisitions of multi, development of multi, the REIT started where we can do short-term financing, right? Which complemented our HUD business really well because you had this 35-year, super structured, super difficult loan to close, in being HUD, and you want to marry it with the most flexible capital possible for a myriad of different reasons, right?
That's a beautiful idea, right? So I'm sure that was a really pivotal point in your business where you realized, well, how do we help them bridge that 6 to 12 month gap? Yeah, I remember. So in my past, I was part of a growing private equity firm. We would acquire a ton of workforce housing, kind of value-add multifamily housing, especially in North Jersey areas, like places like East Orange, Irvington, and so on. Closing HUD loans is like one of the most intimidating things that you could do, but nonetheless,
you need a good tour guide. That's all.
Absolutely. So that must have been killer. Like once you guys landed on the notion, we could start our own mortgage REIT and start raising capital and start,
but
aiding our clients.
But it wasn't, wasn't so rosy day one, right? It takes iterations and time to perfect it to a point where it's really a real value add and a real useful tool. So obviously today we're at that, we've been at that point for years, but it wasn't like that day one. And I think the message is with all the different lines that we've done, the HUD financing, the REIT, the acquisitions, the development, all the different divisions, you just got to continuously evolve, right? That's kind of the basis of it all, just continuously evolve.
Yeah.
Right. And not only evolve with new businesses, but also making those businesses better.
Yeah. Tell us about Dwight Funding. You said that one doesn't really, it might not have been the most progressive step within the ecosystem, but it seems like it was a good step nonetheless. Like, what does that business do? How is that helping you guys today?
Yes, it's that business is effectively like siloed off from the rest of the company, not because for no other reason than it's just not related, right? That said, we have two operating partners again who are just two of the smartest people within Dwight, if not the smartest, the most capable, and we lend to direct-to-consumer brands for AR financing, effectively, right? So there's just a gap between when they're getting paid and from their vendors, and and when they're paying for them to manufacture their merchandise, and when they're getting paid by the retailers, right? There's kind of that gap in between. So that's where we step in, and it's very successful brands like Roan or Thursday Boots or Peeled, to name a few, right? So these are all companies that qualify for bank financing, right? But they don't want to deal with the bank.
Sure.
So they just pay a little more in interest and they deal with a non-bank lender.
What about
instead.
Skims? You in there yet? Alex is a big
I don't
Skims
think so.
fan.
Big Skims.
Yeah. So
in what capacity?
I don't know.
I don't know. I don't even know what it is.
In Jack's mind.
I just know it's a thing. I don't know. Anyways, okay, we'll move on. We want to get into the state of the market and kind of talk about that a little bit. But before that, let's just get into, look, what areas of growth do you see being the most promising right now? And what's the most challenging part of the business for you right now too?
I would say biggest area of growth would be the REIT, right? In general, right? There's the REIT from the mortgage banking side, right? Like I'm kind of carving out the real estate divisions. From the mortgage banking aspect, it's the REIT in general, right? It's just, the book, thank God, is extremely healthy, which is atypical in this environment because, lenders wrote so many poor loans, 2, 3, 4 years ago, which we
absolutely,
thankfully, for the most part, stayed away from. We do have a few bumps and bruises, but, relative to our competition, we're like in a 9.5 out of 10 position, which we'll take all day long. So it's a very healthy book. It's a very healthy stream of business, of new business. And we're just growing and raising a ton of capital because people, again, love the health of our book and love the returns that we're generating. So I'd say that's, in general, that's A. And then B is C-PACE financing, which we just dove into like 2 weeks ago.
Yeah, talk about that for real quick, since that's becoming a bigger thing these days. Tell listeners a little bit more about C-PACE if you can.
Yeah, sure. C-PACE is a very interesting product, like nothing else that exists. You are billed by the tax assessor, right? So it is actually senior to your senior mortgage, right? Which has been a problem, right? Well, first of all, why is C-PACE attractive? Because we'll just cut it to PACE. We don't do the whole C thing. But why is PACE attractive? Because it's a relative to the market, it's a very aggressive, or I would say attractive cost of capital. So these days for non-bank lenders, if you want to get a construction loan from a non-bank lender, it's going to be 11, 12%.
Yeah,
C-PACE is more like 7.5, right? So the big issue with PACE has been senior lenders' reluctance to lend on a project that benefits from C-PACE financing because they don't want to be, subordinate to another loan. They're a senior lender. They're a bank. Right. That's what they're used to. They've written hundreds or thousands of loans where they are a number one priority. Sense. They don't want to be in second position, right? So because through the REIT, we are writing construction loans, conventional construction financing, right? For our clients who don't want to wait for a D4 HUD construction loan, which takes a very long time. It's an amazing program in its own right, but it still takes a long time and isn't for everyone. So we offer conventional construction financing through the REIT. So our idea was, let's marry together, right? Because if we're the senior lender and we're the PACE lender, we control the intercreditor agreement, right? So we're comfortable with our own C-PACE loan being ahead of us.
Right.
It's incredible.
Yeah. Interesting. That makes sense. Yeah.
So now, we'd write a construction loan instead of having a cost of capital of, let's say, day one, obviously we're floating against SOFR. So, and there's a rate cap, so rates can only go down from there. But as it stands today, we're offering like 11% loans, right? When you take the effective interest rate between both C-PACE, which let's say is going to cover like 35% of the stack, and our loan taking the remainder,
top off,
right? So the weighted average coupon is going to drop from like 11% down to like 9.5.
Yeah.
I really hope that our listeners can appreciate the ingenuity that you and your brother and your family have had in building this business. Like I mentioned before, the thought to see the flexible lending side coupled with the HUD, doing something like controlling the that intercreditor spread between PACE financing, construction financing. Like that's real innovation. It's like taking that little thing that causes a nuance. It's something that's very difficult for others to do, or like traditional lenders, banks can't really get comfortable with, and just saying, okay, well we know both sides of this party. We can put that together.
You're filling some voids, and you know where the pressure points are.
Yeah. Absolutely. No, I appreciate that. I appreciate the background.
You just gotta sit in a quiet room and just think critically for like 5 minutes, and amazing what you can come up with. Right?
How's that working out with 2 kids? Do that a lot still?
It's fine.
Do you still find a quiet place? Do you have a quiet room where you can get away from it all?
Yeah, my office. I just don't go home.
So you wanted to bring up state of the market, right?
Yeah.
We like to ask,
Well, I should say that I really leave it on the floor. So I do still work very, very long hours, but once I get home, I get home.
Yeah.
Right.
That's healthy.
I'm not taking calls. I'll be responsive to extremely important emails, but if you can wait till tomorrow, I'll wait till tomorrow. So that's, work really hard, but you have a family, Well,
and you probably work harder the next day because you've segmented it. If you're working all night, sometimes it's hard to just keep that steam going.
It's not sustainable.
Yeah.
You're going to burn out. You're going to burn out, and you're not giving attention to your family, which is like not right. So, and you're not going to be happy. It's just not a good equation.
No, it makes sense. I like that.
So we want to get your State of the Union address, right? What's your perspective right now, kind of America as a whole economically?
Listen, a lot's going on, and we keep hearing about a potential rate cut in September. Everyone's an expert.
I heard about 2 from major banks that were supposed to happen this year.
Someone told me 3. This is all speculation because literally no one has a crystal ball, even though everyone's pretty much banking on a cut coming in September. Where do you think things are going? What's the state of the market right now? Are things just going up from here?
Yeah. I think we've bottomed.
Okay.
I think we've bottomed. I think, it's, do I think rate cuts are necessary? Absolutely. I think we need 2 immediately, right? But in terms of the state of the real estate market, there's just more certainty, right? I would say that the bid ask on cap rates, right? The delta between what buyers thought cap rates were and what sellers thought what cap rates were just 12 months ago was probably like 150 bips, right? Which is a very wide
huge
delta when you're talking about cap rates. Now I think it's probably like 35, 40 bips, right? So it's shrunk dramatically to the point where there's much more certainty in the market, and there's a lot of transactions that are starting to happen. So we went from effectively like no footing whatsoever to now we're like in a muddy footing, right? So there's still a little bit more to go, but at least we can feel the ground.
Are you looking to build sustainable wealth and achieve financial freedom? Viking Capital can help you do just that through multifamily investing, offering a powerful way to grow your wealth passively. Passive investing with Viking Capital allows you to benefit from a lucrative world of real estate without the hassles of day-to-day management. Their team of seasoned real estate experts takes care of everything from sourcing high-potential properties to managing them efficiently, so you can enjoy the returns without the stress.
Multifamily's gotten a bit of a beating over the last year. Where are you guys this year in your lending business versus last year when it comes to something like multifamily? That's probably the vast concentration of your business.
Yeah. We are a significant healthcare lender as well. Just in mortgage banking business in general, we're very, very big in healthcare relative to healthcare size, right? The healthcare universe, I know, is like probably 1% of the multifamily universe, right? There's 4,000 or 5,000 nursing homes in the country. Think about how many multifamily properties there are. But I would say lending in general, it's unfair to compare this year or even last year to 21 and 22 directly.
Agreed.
Right? Because those were just
not real years,
all-time record years, right? Yeah. But if you take, the previous 5-year average, right, we're not too far off. We're probably like 25% off across the board, which is fine, right? Not a big deal.
Yeah. So
it's more, I would say it's, the way I like to equate it was like a couple of years ago was Barry Bonds steroids era, 70 plus home runs, just monster, right? And now it kind of went to like more of a Ichiro, right?
Okay.
Or you're still batting high average, but just a bunch of singles.
Yeah.
And now it's kind of like a Vernon Wells. It's in between. It's trending towards a Vernon Wells for those baseball
sports
fans.
analogies.
Yeah,
I love that.
And if you don't get the analogy, that's a you problem.
That's a you
problem.
Can
Google it. I'll probably Google it later, but we're good. Yeah.
So we were talking about, you kind of start out by saying you think the market's going up from here. Going back to multifamily, do you think values have kind of plateaued? We were talking about the bid-ask spread. So
no. I just think values are going to go up from here.
Got it.
You see more capital getting deployed now, and you can really. I mean, I can
people
tell
are
you
comfortable.
Absolutely, and I can speak for the multifamily market and DFW and in Texas. It's moving, right? It really is. It's starting to feel like we're in a good spot again. And to your point, the bid-ask gap has kind of narrowed, and I think everyone's kind of on the same page now, and expectations are getting a little bit more realistic, which is nice.
Yeah, both sides are giving in.
Yep.
And I think what's in the back of everyone's mind is just a supply cliff, right? Q1 2025, the supply of multifamily just falls off a cliff. If you look at the charts, it's literally like that.
Right.
And people recognize that, and there's not much construction going on.
Yep.
Because it's just not economically feasible for. I think multifamily construction starts are down like 90% from 2 years ago.
Yeah.
And we're seeing it ourselves, right? In the amount of deals that we underwrite versus the ones we actually fund,
Sure.
Right? It's crazy. So supply is going to be constrained for a couple of years, and I think that's just going to give existing multifamily owners the ability to raise rents and
if you have,
value.
a lot of our developer clients is the same thing over and over again that we're kind of hearing. But I mean, if you can have, a new project come online in 2026, 2027, you should be able to crush it.
Yeah.
That's the money. The problem is just getting the financing, which has been the difficult part. So I'm curious, what are you doing with some of those new projects, right? I mean, with some of these construction loans coming due, are you guys filling a void there? Do you have more business in sort of that new sort of development space now than you did before? Or
yeah. The opportunities are growing by the day.
Yeah.
And we're just off, right? It's like, I would say 3 months ago, deals didn't pencil as well as they do today. Mm-hmm. It's still not good enough today, but it's trending better. And I think the whole, CPACE plus DMT, Dwight Mortgage Trust, our mortgage REIT, conventional construction financing, when they're married together, when you're able to bring down that cost of capital just that much, right? It really makes a difference on many projects.
Yeah.
So CPACE is helping your borrowers. Is there anything else that has aided that, penciling?
Construction costs have come down, right? Lumber's tumbled, right? So supplies being sucked up in many submarkets, right? So in some submarkets, it's still a major problem, but in other submarkets, 2, 3, 4 projects there were locally have all been leased, right? So it's giving people the opportunity to enter the market and build new projects.
What markets are you guys bullish on right now? Where do you guys like to lend, geographically speaking?
I would say we're still very bullish in the Southeast, right? Just Southeast, Florida, Texas. That theme is continuing. I think the Northeast is very strong, right? Just because throughout the boom in all these growth markets throughout the country, there wasn't much construction in the Northeast, right? And now we're seeing that undersupply, seeing those undersupplied markets just have so much demand. Also, like the Northeast is generally speaking, like Jersey, New York, Connecticut, parts of Pennsylvania are just so bureaucratic that there are just so many excellent submarkets that just haven't seen new product in 10, 20, 30 years.
Yeah.
Right. So developers are coming in and they're able to get through this arduous bureaucratic process and build their project, and they're being, 100 units are being leased up in just a few months.
So would you say you guys are good at pinpointing kind of the microcosms of smaller locations, sub markets?
Yeah, whether we like it or not, because because just based off the deal flow that we see, right, we just know we effectively are aware of every submarket in the country.
Yeah,
which is a very unique view.
Yeah,
not everyone has that.
You want to take him to the dark side? Should we get into the dark side of loans?
Oh man,
I'm not going to comment on specific companies that are dealing with some turmoil right now, but in general, it's sad to see. I just don't, even if it's a serious competitor, you don't want to see anyone suffer, right? It's just not. It's not what I like. I like good competition, healthy competition, right? But to see, so many firms suffer, so many people suffer is just not a good thing.
And by the way, I should note, a lot of the negative press out there, I think a lot of the news likes to play up the negativity, and I think sometimes it gets played up a little too much. So when we talk about,
I don't think so.
You don't think so? I think some of this is a little overhyped, and I think people think so. No, okay, no. This is good. This is what we want.
So let's hear. I mean, at this point, I don't think anybody's more deeper involved in the market than you. What are you seeing out there?
I mean, it's more so what we saw, 2-3 years ago when competitors were writing.
And you're asking yourself, how the hell did this pencil?
It just deals made no sense, right? I mean, you'd have we would I remember specifically a deal where we really stretched on it. It was in Phoenix City, Alabama. Okay. Has like
thriving.
It has like
thriving, huge market.
No offense to Phoenix City, Alabama, but I think they have like a casino, like singular.
Yeah. We just lost 10 followers.
Yeah.
Maybe they have more, but that's what I recall.
Yeah.
And the only reason why we got like somewhat aggressive on it was because it was a HUD loan that we were processing already. We already had all the thirds and due diligence and everything, and the sponsor we were working with decided to sell the property to a buyer, and we came in aggressive at like an aggressive spread, and we were bidding at like 75% of cost plus 100% of CapEx dollars, which there wasn't too much CapEx, but still. And we're like, okay, like this is a really aggressive bid for Phoenix City, right?
Then not Phoenix.
Yeah, Phoenix City, Alabama.
Yeah.
And all of a sudden, the client calls us and is like, yeah, I have a bid at 85 plus 100. And the spread was like, I don't know, 50 bips tighter than ours. And I was like, okay, that's, when you combine the 85 plus 100, that's 95% plus financing. And I was like, okay, this doesn't make any sense. I mean, this is just one example of many. I mean,
and this comes into interest rates and the whole extend and pretend, mantra that everyone keeps talking about.
I hate that. That slogan.
Extend and pretend. You're a little tired of it.
What about, like, who are we kidding?
What about survive till 2025? I mean, what happens?
Well, at least survive till 25 gave the implication that we're going to try our best, but extend and pretend. Extend and pretend says we give up.
That's like fake it till you make it. I don't like that line.
Yeah. Well, I'll tell you. Let's just talk about Arbor real quick. Viceroy Research is a company that really called out Arbor, and Arbor's now the most heavily shorted property stock in the country for their CLOs mostly. And according to Credit IQ, around 9% of Arbor's securitized debt is 30 days late on payments. But look, I mean, I know they're working with a lot of their borrowers, and there's a lot of loan modifications happening, and perhaps a lot of these guys come out of this okay, right? If rates do come down in September, and again, maybe another decrease by the end of the year, maybe maybe it's just enough to kind of come out. And certainly there's already been a lot of blood in the streets, but maybe not as bad as it could be.
You bullish on that sentiment?
I, for the most part, yes, because at the end of the day, everyone's in it together, right? For all these troubled loans, it's not 1 or 2 or 3 defaults. It's a mob, right? You have a book of 1,000 loans and 400 of them are in default in one way or, whether it's technical or monetary default, whatever it is, right? Like, then you're talking about the sponsor, the lender, the, investors, shareholders, whatever it may be. They're all kind of in it together.
Right. And even with securitized debt, right? I mean, with CLOs, the lender's still on the hook for some of that. Yeah. So everyone's incentivized to get to the finish line in one way or the other. Right.
If it's just 1 or 2 or 3 defaults in a book of 1,000, okay, you're going to take care of them, right? But if it's significant portion of the book, like it's not that simple. So everyone's going to work together, right? Everyone's going to work together on bespoke modifications, right? On evaluating whether it's your basis is good enough to hold on and pay down the principal a little bit or maybe get a little interest rate relief, right?
Yep.
Right, but there are going to be times where, it just upside down, right?
Yeah.
The deal is just unbelievably upside down where you're 150 LTV and there's no light at the end of the tunnel for years and years ahead of us.
You got to cut it loose.
You got to cut it loose, right?
And speaking of credit IQ, they dropped a kind of a crazy stat earlier this week. They were specifically talking about multifamily loans with CMBS financing. They said that there was 185% increase in distress. So whether it's maturities, technical defaults, mods, whatever it is, there's been 185% increase just from the start of the year up until like last week in July. Maturities is
which is funny, by the way, because like a lot of times that means it went from like a 40 bip default rate to like an 80 bip, right?
Yeah.
But then they'll quote only the percentage, but not the actual.
Yeah. Well, I think this is part of the narrative,
the percentage
right?
increase as opposed to the
that's kind of all part
increase.
of the narrative. Is there is a little bit of this doom and gloom, right? And then you get kind of the naysayers saying, "Oh no, it's like sponsors speaking to their own behalf." I mean, how much of that is really true? There's a ton of maturity pressure. There's $1 trillion of loans maturing in the market. It's up, almost like 30% since 2023. But it's just obviously it's up. You're moving maturities from one year to the next. Like, what happens at the end of this tunnel, right? Like, what's your prediction? Where are we coming out in the next 6, 12, 18 months?
So I think the vast majority of sponsors will be fine, right? But there's going to be there was the sponsors who are professionals. They know what they're doing. They're well capitalized. They weren't cowboys. They just got kind of caught in this interest rate hike, bubble. For the most part, they're going to be fine, right? Because they have the wherewithal, they have the capability, they have the history, and lenders are really going to work with them. Right, it's the fly-by-night syndicators that are going to get hurt, right? Which I think was the intention when Powell started raising rates. Right, he kind of wanted to get rid of the froth.
Yeah, which no one likes to see anyone lose anything with. I mean, it's unfortunate, right? But I guess part of that's how it works. I mean, it was getting too hot,
especially these syndicators who are crowdfunding and. They're raising very small checks from people who maybe shouldn't be investing in deals and who aren't as educated as they should be prior to these investments. It's heartbreaking. Or it's awful. It's not good.
Right.
But and it's funny. I mean, I wouldn't call it funny, but it's interesting because when I first started, when I started my career, which is right after 2008, I was like, kind of understanding the carnage that was going on, and I was like, how can people get involved with these deals? Like, what were they thinking?
Yeah.
Like, this can never happen again.
Yeah.
Right? This optimism, this
human psychology. Until you
saw it happen again.
This greed.
Like, and then it'll happen again and again.
And I thought, no way. It's over. This is the last time. I mean, if you remember 2008, the world came to an end. Like people thought that was it. And here we are again.
Right.
So it just goes to show you everything is cyclical. Human nature is always going to be there.
Yeah, it's a real mixed bag of sentiments, kind of like part of it does feel like a weight in a sense. And again, I know I'm going to get crucified. You're going to have people saying, no, it's nothing like that. It's not liquidity crunch. It's not banks failing. Who the hell actually knows, right? I mean, we spoke about it on a previous episode where the 30 largest banks in the U.S. got stress tested, and then J.P. Morgan raised their hand and said, "Actually, we stand to lose a lot more than you guys predicted." Right? So
it's like a flex now. Who can lose the most?
Who can lose the most? So it's kind of all over the bag, but it's good to hear from somebody who's so involved in the business, who has so many lines that are synergistic and really like tangential to every side of real estate. It's good to hear your perspective.
My question is, how many Ferraris do you have? Because once you have 2 or 3 Ferraris, I think it's a clear sign the market's gotten too hot.
Yeah.
And that's what I see. When I start seeing brokers going out and buying a Ferrari or 2.
Jack, he told us his credit is decimated. You can't ask questions.
No, it's I like nice things, but I don't like unnecessary things.
No. What's a nice thing for you? Totally off topic.
I would say sneakers.
Sneakers are cool.
I am a sucker for Tom Ford sneakers.
Yeah.
And most people who know me know that.
Here's my problem, right? You wear them, you spend all this money on your sneaker, but they're the first thing that touches the ground. So 2 days later, they're dirty. What do? You just got to clean it every day? Or
no,
what's the maintenance?
You throw them out
things?
and you get new sneakers.
You get some new ones.
No, you just gotta take care of them.
Little CapEx here.
Did you grow up loving sneakers as a kid?
No.
Wearing a sneakerhead?
No, I mean,
Jordans.
You're a big sports guy.
Maybe from basketball sneaker perspective, yes,
right.
But not like a daily.
I'm sure you didn't love Tom Ford sneakers when you were.
I don't even know if I don't think Tom Ford existed. No, but it's the key, and this is what most people don't understand, is the key to really nice sneakers is you can't just have one. You have to have a few, and you have to rotate.
You got to rotate. That's the problem.
And then there's longevity. Just increases.
See, I'll get some and I love these shoes, and I'll just wear them too much, and then next thing you know,
Jack's still wearing his Chuck Taylors from 2005.
You gotta keep those in the back pocket.
They've
just in
gotten
case.
out of hand, though. At the office, right?
Yeah.
No one wears traditional leather lace-up shoes like they used to. Everyone's wearing these tennis shoes.
Hey, financial analysts out there on Wall Street and the 6 who decided to finally tune in here. Can we cut it with the business casual and the multicolored Hoka sneakers? Can we put that to sleep?
My dad wears Hokas, and no shame on my dad.
For the record, Jack's dad is in his 70s.
My dad's a cool guy, and he'll listen to this, and he's a cool guy. Don't get me wrong. I'm just saying, Hokas, they've had their day. No? Do we need to be wearing them to work?
Yeah. There's only 2 people who should be wearing Hokas.
Who's that?
Senior citizens and people who need a couple extra inches.
That's a wrap, folks.
Oh, right.
Hey,
you heard it there.
Hey, Josh, it's been great having you on.
Well,
I love hearing your background.
Before you finish,
please.
It's one point I like to make, which I think is very important, in that I thought that the destruction with higher rates would be much worse. There are 2 things I didn't take into account. One is specific to this, crisis, and the second is more of a general idea. The first is I didn't realize the impact of people making, 5% of their savings account would be. Yeah. Right?
Right.
And that's just not individuals. That's companies, that's corporations, it's private equity, who are just sitting with so much cash and they're generating, risk-free, legitimate risk-free returns. I didn't take that part into account and what that would do. Mm-hmm. And second, which I think is very important for everyone to remember long-term, is humans' ability to innovate through problems, right? It's not like the market where the problem just started is going to continue that exact way. People are going to adapt. They're going to innovate their way through their problems. And I completely discounted that idea.
Yeah, makes sense. No, that's nice to know. Thanks for sharing us, your background, the business, where you see the markets, and your thoughts on shoes. It's all good stuff. It was fun talking to you.
Thanks for having me in your sprawling
East Village studio.
Yeah,
that's right. Hey,
thanks
for coming, guys.